In this chapter, I'm going to give you a brief overview over derivatives, and I'm going to give you a formal definition of what derivatives are. Then I'm going to provide you a few simple examples to illustrate how they work. And then I'm going to show you in which markets they are traded, who are the typical traders, and for what purpose do people actually trade derivatives. So we're going to see what is the actual economic value of derivatives. And then towards the end of the chapter, we are also going to look at some cases which show somewhat the downsides of derivatives. So to start with a definition, a derivative is a financial instrument whose value depends on or derives from the value of an underlying asset or variable. So the first key characteristics is that a derivative has a limited time to maturity. So that's in stark contrast to, for example, stocks. With a stock, you buy part of a company, and basically you're going to have that ownership of that company forever or until that company goes bankrupt or you die. With a derivative, there's a really set time limit. So it has a certain time until it expires, and after it expires, it just disappears. Now, the payoffs of the derivatives are all made anytime before the maturity or just on the maturity date. And these payoffs are going to be well-defined functions of some unobservable underlying variable. It could either be a traded asset, or it could just be something else which all the market participants can observe and exactly determine its value. The key ingredients to determine the current value, so that's not the payoffs, but the current value today, which is in some sense the present value of all the future payoffs, are the characteristics of the underlying variable on which the derivative is written, and in particular the current level of that underlying variable, also its volatility, or in other words, its dispersion, meaning by how much it can increase or decrease over the lifetime of the derivative, and potentially some other characteristics. Of course, it's going to be crucial when the derivative actually matures, so how long is the lifetime of the derivative, to determine what is the current value of it. And as we will see, one very important ingredient is also the risk-free interest rate. And that's also why we're going to spend quite a long time talking about what are risk-free interest rates and how we do calculations with risk-free interest rates. So to get to some examples of derivatives, so we have futures and forwards, and these are really kind of the most simple derivatives which you can think of. In particular, forward contracts are really kind of contracts which existed since ever human beings started to trade with each other. The idea of a forward is that you sign a contract where you determine to what price you and what underlying you buy or sell. And it just, instead of trading it right now, you set a specific point in time in the future when that trade will take place. Interest rate swaps would be an exchange of two interest payments on some principal amount. So you could think of, for example, I sign a contract with you. I agree to pay at the end of every month the current 1 month floating interest rate, which changes every month, on a certain principal amount, let's say 1 million Hong Kong dollar. And you always just give me a fixed interest rate payment on that 1 million Hong Kong dollar in return. Okay, so maybe you pay me every month 1% annualized, and I would just pay whatever the current 1 month interest rate is in the market. For foreign exchange swaps, instead of exchanging interest rate payments, I would pay you, let's say, in Hong Kong dollars, and you would make me payments in, let's say, US dollars. For a credit default swaps, these contracts basically are an insurance. So one party pays a premium, and the other party just pays a big lump sum payment in case a certain company or a certain bond defaults. Options, warrants, and convertible bonds, these are basically contracts which give an option value to one party to decide whether he wants to buy or sell an underlying asset at a predetermined price. Asset-backed securities and as a special case, mortgage-backed securities. These are quite interesting contracts which came under scrutiny in the global financial crisis. And these are basically contracts which combine many securities together and then give payoffs based on the value of these securities. And I'm going to give some examples towards the end of this chapter. Structured products, these are basically portfolios of different derivatives. So you're going to combine different derivatives together, and so you get a kind of more complex derivatives. These structured products, they are typically sold by some financial institutions to their client to give them somehow a more tailored risk exposure. Then what are the underlying variables of derivatives? Well, basically, you can choose almost anything as long as it is observable and market participants can agree on its current value. Typical underlying variables are stocks. Then you can also have bonds or interest rates. It could be foreign exchange. Then you can also have derivatives written on commodities. Commodities can be a lot of different things. It could be grain prices, it could be livestock, it could be meat, it could be oil, that includes crude oil, heating oil, etc. It could be metals like gold, silver, and so forth. And you can also have credit risk as an underlying variable. So for example, for these credit default swaps, where you basically give an insurance, one party sells an insurance to another party, depending on whether a certain company defaults or not. And then you can also have other things like, for example, energy, or in other words, electricity. You can look at the weather, so how much rainfall you have in a certain time period, in a certain location, or how hot the temperature is in a certain location. All you need here is you have to determine which kind of weather stations are used to determine either the rainfall or the temperature, so that all market participants can agree on what the actual values are in these weather derivatives. And then you can have any other kind of like insurance payouts. And finally, you can also have derivatives as an underlying variable, such as a futures price or a swap. So what does it mean? It basically means you can write derivatives on derivatives, and that's where things become really difficult. Let's look at one very simple example of a derivative, and we're going to talk about this much more in chapter 3 as well, and that's a derivative of a forward contract. A forward contract is an agreement to trade an underlying asset at a future point in time, which we also call the maturity. And in our course, we denote that maturity by capital T. And so you sign that agreement to trade the underlying asset at maturity at a fixed price, which you specify today. Okay? And we call this the forward price F, which you agree upon at time small t. And here in the superscript, we write the maturity date capital T when you actually agree to trade that security. Okay? And the current time we denote by this small t. So the party that agrees to buy the underlying asset, we also call him the long position in that forward contract, and he makes a profit whenever at maturity capital T, the price of this underlying asset, let's denote it by S at time capital T, if that is higher than the forward price which you have agreed to pay to get that underlying asset. So that means his payoff is really going to be the price of the underlying asset at the maturity date minus what he has agreed to pay. Okay, so whenever this thing is positive, he makes a gain, and on the other side, if the price of the underlying asset is lower than the pre-agreed forward price F, then he makes a loss. Then on the other side of that trade, here's the party that agrees to sell the underlying asset, and we call him also the short position in that forward contract. And this guy makes a profit whenever the price of the underlying asset ends up lower than the forward price F, okay? And on the other side, he makes a loss if the price of the underlying asset is larger than the forward price. So overall, we can write his payoff at the maturity date as the forward price which he receives, since he agreed to sell the underlying asset, minus the price of the underlying asset, because, well, he has to deliver that underlying asset, and that is worth ST at the maturity date. Okay. Now, how do the parties choose the forward price FT? Well, typically, the convention is that you choose FT such that no money has to be exchanged at the initial time, small t, where the long and short position agree to enter this contract. Or in other words, that means the present value of either long or short position is just zero at the time where you sign the contract. Now, present value being zero doesn't necessarily mean that there's no economic value to either the long or the short position. There could be many different motives why long and short positions want to take the positions which they sign in this contract. For example, the long position may believe that the price of the underlying asset increases a lot in the future. And so for him, he actually thinks that this is going to be a very lucrative trade. Okay. And maybe the short position says, well, I already have that underlying asset. I really want to get rid of it at that maturity date, capital T, and I'm really scared about that the price may drop a lot. So one way I can lock in the price is by just agreeing right now at which price I'm going to deliver it in the future. Okay, so even though the present value for both long and short position is zero, it still has some economic value for these two parties. So let's look at a more specific example of a forward contract. Let's suppose today is June the 4th, and let's say you're the treasurer of a corporation which enters into a long forward contract with a bank to buy 1 million British pounds in 6 months at a fixed exchange rate of $1.55 per pound. So what does this mean? Who has an obligation in this contract, and what is the obligation? Well, both parties, the corporation and the bank, have an obligation. For the corporation, the obligation as a long position is that, well, the corporation has to pay the fixed price of $1.55 a pound, or for 1 million pound, they have to pay a fixed amount of $1.55 million. And on the other side, they will receive 1 million British pounds on December 4th. On the other side, the bank, as a short position, also has an obligation, and their obligation is to deliver the 1 million British pounds. Okay? And on the other side, they are promised to receive that fixed price of $1.55 million on December 4th. So what is the payoff of the forward contract for different possible values of the exchange rate on December 4th? Let's suppose that the exchange rate on December 4th actually drops to $1.45 per pound. Well, then the corporation has a long position. They will receive 1 million pound, is now worth $1.45 per pound. So meaning it's worth $1.45 million, but they have agreed to pay that fixed price of $1.55 million. And so that means if the exchange rate ends up at $1.45 per pound, then they have a loss of $100,000. Now, most of the time in practice, instead of actually delivering, the bank delivering 1 million pounds and the corporation paying $1.55 million, what these market participants would say, well, look, the £1 million is worth $1.45 million. The corporation has to pay 1.55 million, then let's just settle by paying the difference. So in this case, meaning that the corporation would have to pay the bank just $100,000 cash. Okay. Now, if they still want to buy the British pounds, they can also just go to the spot market and exchange 1.45 million US dollar into 1 million pounds. Okay, then now on the other side, the bank as the short position, what is their payoff again? So they receive the fixed cash flow of 1.55 million US dollars. That's that fixed price which they have agreed to receive if they deliver 1 million pounds. On the other side, they have to deliver the 1 million pounds to the corporation. That 1 million pounds is worth $1.45 per pound, meaning therefore they have a gain of 100,000 US dollars. And that makes a lot of sense, right? Because we just said before, the corporation has a long position, effectively has to transfer $100,000 to the bank. And so you see here that these forward contracts at that maturity date, the payoffs are always a zero-sum game. So one position gains something, one position loses exactly that amount which the other party gains. Now, let's just for completeness look at some other values. What happens if the exchange rate is 1.5 US dollar per pound? Well, in this case, the corporation has a long position. They have to again pay 1.55 million US dollars. They receive 1 million pounds worth now 1.5 times 1 million, so 1.5 million US dollars. Again, if you look at that difference, that still amounts to a loss of $50,000. On the other side, the bank, as the short position, they have to deliver the 1 million pounds, which is worth 1.5 million US dollars. They receive the fixed price of 1.55 million US dollars, so they make a gain of $50,000. Again, in practice, instead of actually moving around a lot of money, what they can just do is they say we settle in cash, meaning that the corporation just transfers the 50,000 to the bank. If the exchange rate ends up exactly equal to the forward exchange rate or that forward price of $1.55 per pound, well then actually the payoff is zero to both the long and the short position, because now what the corporation receives is just 1 million pound times $1.55 per pound, which is 1.55 million US dollar. That's exactly the same as what they have agreed to pay initially. So payoff is zero. And again, for the bank on the other side, they get the fixed price of 1.55 million US dollars, and they have to deliver the 1 million pound, now also worth 1.55 million US dollar. Again, payoff of zero. So basically no one has to pay the other party. What if the pound actually appreciates against the US dollar? Let's say it's worth $1.6 per pound. Well, now that's good news for the corporation, because now the 1 million pound which they receive is worth 1.6 million US dollar. They pay that fixed price of 1.55 million US dollar. That means their payoff is positive, it's 50,000. On the other side, the bank, an increase in the price of the underlying is bad news. Well, because they have to deliver the underlying of 1 million pounds, which is now worth 1.6 million US dollars. And on the other side, they only receive the 1.55 million US dollar. So that means for them, this is a loss of $50,000. So again, with cash settlement here. Now, what it means is that the bank has to pay 50,000 US dollar to the corporation. And the last example is if the pound actually appreciates even more to 1.65 million US dollar per pound. Now the corporation receives the 1 million pounds worth 1.65 million US dollars. They only pay 1.55 million US dollars. So their gain is 100,000 US dollars. And for the bank as a short position, since they have to deliver the million pounds, which is now worth 1.65 million US dollars, and they only receive the fixed price of 1.55 million US dollars, that means they make a loss of $100,000. So what is the importance of derivatives? Derivatives take a key role in transferring risks in the economy. In the example from before, what does it mean transferring risk? Let's suppose that the corporation actually knows that it needs £1 million to buy something from the UK in the future. And so they are really exposed to exchange rate risk, because if the pound appreciates, it means that they have to pay now more to get £1 million to buy whatever they need to purchase. And so if they sign that forward contract, it helps them to reduce that risk, or in other words, transfer that risk to the bank. Now, we know that in practice, many financial transactions actually include derivative contracts, so they seem to be very popular, and I'm going to show you some statistics of how big these markets are just in a minute. The last thing, and we're not going to touch on that in this course, is applications in corporate finance. So in corporate finance, we often have to value different projects. You have to figure out what is the present value of, let's say, a corporation undertaking a certain investment with certain payoffs in the future. And a lot of times, real projects have certain derivative values embedded in them. We call them also real options. So a real option would, for example, be if a corporation can wait, let's say, 6 months to decide whether they want to enter a certain market. Within that 6 months, they can learn whether there's going to be a very high demand in that market or the demand is going to be rather weak. And so delaying that decision of whether they want to make big investments to really enter that market is actually quite valuable to them. So they would only actually want to enter the market if the demand is strong, but they don't want to do that if the demand is weak. And you can use a lot of the concepts which we learn in our derivatives class, where we actually focus on pricing financial contracts. You can transfer these concepts into valuing these type of real options. So how are derivatives traded? There are really two platforms. One is on an exchange and the other one is called over-the-counter. Exchanges are platforms which are provided by institutions where traders can meet and trade the contracts which that platform or that exchange specifies, and the exchange, of course, takes certain guarantees that there are no defaults and decreases the risk of fraud. We have a lot of different exchanges where you can trade derivatives around the world. In Hong Kong in particular, we have the Hong Kong Futures Exchange, the Hong Kong Stock Exchange, and the London Metal Exchange. In China, you also have a few different exchanges where you can trade derivatives. You have the China Financial Futures Exchange, then you have the Dalian Commodity Exchange, and that apparently is actually the first derivatives exchange which we had in China. Then you have the Shanghai Futures Exchange and then Zhengzhou Commodity Exchange. In the US, really the biggest one is the CME Group, which includes the Chicago Board of Trade, the Chicago Mercantile Exchange, and the Chicago Board Option Exchange. However, you also have many other exchanges in the US. So you have, for example, the New York Stock Exchange, which includes derivative trades. You have American Stock Exchange, the Philadelphia Stock Exchange, and so forth. And actually, in more recent times, trading of really any kind of financial contract has become more fragmented, meaning there are much more like small exchanges developing. And a lot of that is also due to the ability of trading through the internet and executing electronic trades versus the need of actually having a physical platform where traders meet. And then finally, in Europe, you have most prominently the Eurex, but then you also have many other smaller exchanges, especially like country-specific exchanges. Now, in contrast to exchanges, we have over-the-counter traded markets, and the over-the-counter traded markets means really just two parties, they meet just anywhere outside of an exchange and they write any type of contract which they like. So over-the-counter traded markets are a little bit more flexible than exchanges because you can really write any kind of contract which you like. So there are no set parameters for what the contract has to look like. So this is in stark contrast to the exchange, where the exchange actually tells you what type of contract you can trade. Over-the-counter traded markets are also more flexible in the sense that there's much less regulation. So that gives more flexibility to traders to also take maybe more leverage, which is maybe a good thing for traders, but maybe not so good for the overall economy because it can lead to some big defaults. Again, we're going to touch on that a little bit later in this course. Now, just to show you the relevance of over-the-counter traded markets, so these OTC versus the exchange-traded markets, the line here on top, that shows you the market size in trillions of US dollars of over-the-counter traded derivatives, while the line here on the bottom shows you the size of the market of the exchange-traded derivatives. Notice to set these numbers into comparison. So first of all, these numbers are total notional principal amounts of derivatives. And what does it mean, notional amount? It means this is not the present value of a derivative contract, but this is the value of the asset which is underlying the derivatives, or how much is the derivative actually subject to exchange. Okay, so if you go back to our example of that contract between the corporation and the bank, where they sign this forward contract, where the bank delivers £1 million and the corporation pays a fixed exchange rate of $1.55 per pound. In this case, the notional value would be this £1 million times 1.55 US dollar per pound, or 1.55 million US dollars. Now, remember, this forward price was actually set so that the present value for both the long and the short position is 0. So the notional amount of $1.55 million is much higher than the actual present value of this forward contract. Okay, and what we plot over here, these are the notional values. Okay, now why is there such a big difference between OTC derivatives markets and exchange traded derivative markets? Well, the reason is most likely due to the fact that there's much less regulation in over-the-counter traded derivatives. So it makes just trading these derivatives more attractive to financial institutions or traders in general. And so they rather choose to trade in private and not on these public exchanges. Another thing is also just most contracts like swaps, for example, and forward rate agreements, which are all interest rate derivatives, most of them are just not traded on exchanges. They're only available OTC, okay? And so that also probably explains a lot of that gap. I'm going to provide you a breakdown in about 2 slides. So if we compare these OTC notional value of derivatives, which is about $600 trillion, and for the market exchange traded derivatives, it's maybe somewhere around $50 trillion. If you compare that to the 2010 GDP of the entire world, that was only $66 trillion. So you see, in these derivative markets, you have contracts which actually are written to exchange something which is about 10 times the value of what the entire world produces within a year. And also, if you look at, for example, US GDP in 2010, that was 15 trillion, and the GDP of China was $6 trillion. So just showing that really these derivative markets are enormous. A lot of assets or a lot of value of assets are actually subject to be exchanged under these derivatives. We can also make this comparison to stock market capitalization for the entire world. That's 55 trillion. For the US, it's 17 trillion. And for China, it's 4 trillion in 2010. Again, these numbers are just about 1 order of magnitude smaller than the notional value of these derivative markets. Now you could say, well, okay, these are notional values. How does this compare to the actual market value or the present value of these contracts? Again, going back to that exchange rate forward, where we said, well, notional value is like 1.55 million US dollars, but the present value was 0. So how does that compare? Well, there is a huge difference. Okay, notional value is like $600–700 trillion, while the market value seems much closer to 0 actually on that scale you don't even really see how big that is. Okay? As a comparison down here, I again list the GDP and stock market capitalization just to get an idea. I want to zoom in a little bit afterwards on these market values down here to illustrate you that these are actually still pretty large. Okay, I'm going to show you that soon. Before I do that, still looking at notional values, I just want to slice up these derivative markets, looking at different types of derivative contracts. So here, that red line over here, that shows the notional value of derivative contracts written on interest rates clearly dominate the entire market. So most of the notional value comes from these interest rate derivatives. In comparison, we have as the second largest market, that's that blue line over here, that's for foreign exchange rate contracts. Then we have credit default swaps. They were quite popular before the global financial crisis, 2007, 8, and 9, then dropped a little bit, but actually still are somewhat relevant. And then actually the smallest part are derivatives written on commodities and equities. However, for our course, it turns out that equity and commodity derivatives are kind of the easiest to price. So as an introductory course into derivatives, actually most of our focus is going to be about these two markets, okay? But just to keep in mind that actually really the most important market is the one for interest rate contracts. So maybe at this point you also may say, well, okay, this looks like interest rate contracts are really most important in terms of notional amount, but maybe the present value of contracts look quite different. So let's look at what is the actual present value or market value of these contracts. Again, we see that interest rate derivatives, they clearly dominate. So most of the value of the market value of derivatives comes from these interest rate derivatives. And then quite similar to previously, we have here the foreign exchange contracts, the credit default swaps, and then equity and commodity linked derivative contracts. Just to look again at the magnitude of the market value. So you see that, well, there is quite some fluctuation, but overall, if you add up everything, you're probably somewhere in the range of about 20 to 25 trillion dollars. And again, this is now not the notional value, this is the actual market value. That's the present value of all the derivatives which are outstanding. And just to put this into comparison, that's about half of the market capitalization of all the stocks, so meaning all the values of all the publicly listed corporations in the world. And it's also about half of what the entire world produces in any given year, or here in 2010. Okay, so again, just illustrating that not just the notional value is massive, but actually also the current value of these contracts is very big. One thing, if we talk about exchanges versus over-the-counter traded markets, one important characteristic is credit risk or default risk. If you trade on an exchange, then basically the exchange makes sure that your counterparty is not going to default. So you're always going to get the promised payoff. How does an exchange do that? Well, basically by requiring some collateral. So if you enter a certain position, you will have to post some money or deposit some money with an exchange so that the exchange can be sure that in case if the derivative moves against you and you have a liability, that you can actually make these payments. Okay? In over-the-counter traded markets, that may not be the case, and things can be much more complicated. It could be that one counterparty goes bankrupt, and then the other counterparty may not get its promised payoffs, or may need to suddenly unwind some position, which can lead to some big trouble. And just to illustrate the importance of this credit risk in over-the-counter traded markets, we want to look at that example of Lehman Brothers. Lehman Brothers was one of the very big financial institutions before the global financial crisis in 2008. And Lehman Brothers was really kind of a corporation which you can compare to Goldman Sachs, for example. So they were very big, they were very prestigious, and they really employed kind of the smartest people in finance. Okay, so if you got a job offer from Lehman Brothers, you could be very proud, and it's very similar to getting a job offer nowadays from, say, Goldman Sachs. And Lehman Brothers went bankrupt on September 15th in 2008, and it was one of the biggest bankruptcies in the US history, or if not the biggest bankruptcy. So Lehman was a very active participant in over-the-counter traded derivative markets, and they had a lot of risk exposures in these markets. Just to illustrate of how active they were, they actually had hundreds of thousands of different transactions outstanding at the time when they went bankrupt, and they had about 8,000 counterparties, which included other big financial institutions like Goldman Sachs, Bank of America, HSBC, and the list goes on. Now, unwinding all of these hundreds of thousand transactions was quite a pain. And it took actually months and months for liquidators to deal with the bankruptcy of Lehman Brothers. And of course, it was a nightmare for all the counterparties because there were so many outstanding positions. Banks who traded with Lehman didn't immediately know how much risk exposure they actually have now because all these positions are going to disappear. So that meant that this bankruptcy of Lehman Brothers actually caused very big shock waves, which went through the entire financial industry. And very big fears arose that there might be some domino effect, that the bankruptcy of Lehman Brothers may spill over on other financial institutions, and there might be many more defaults because of that. So you can think of that both in terms of, if I'm HSBC, I have maybe a few hundred transactions with Lehman Brothers. If they go bankrupt, first of all, they will not pay me anymore the money which I expected that they will pay me at some future point in time, which is painful for me because I lose some value directly. But on the other side, they also are not here anymore to trade into these derivatives, which maybe helped me to offset some other risks. So now my risk exposure is suddenly much higher, and that is going to be quite troublesome to me because maybe now I have to sell certain of my asset or have to buy some other derivatives to again balance the risks on my balance sheet. And of course, for an institution, let's say like HSBC, it wasn't immediately clear of what are these implications going to be. The second problem with that bankruptcy of Lehman Brothers is also that once Lehman Brothers went into default, all their assets had to be liquidated. That means there was a huge fire sale going on, which caused a lot of downward pressure on asset prices, which of course also meant that other financial institutions' balance sheet are going to look much weaker since a lot of asset prices are going to decrease. So because of these fears of this domino effect and many potential more defaults of big financial institutions, no one actually wanted to lend to other financial institutions anymore. And that's what we call the credit crunch, okay? So no one lending to each other anymore and no one lending to the real economy anymore meant also, of course, that the economy slipped into a very deep recession. Now, what was the way out of this? Well, if you don't want to end up with like a big depression like in the 1930s, well, you needed some big intervention by the Federal Reserve Bank and other central banks around the world. And indeed, after the bankruptcy of Lehman Brothers, the Fed has bailed out a lot of financial institutions, meaning they have injected a lot of money or bought a lot of the bad assets from these financial institutions to give them support so that they don't go bankrupt and to stabilize the economy and help the economy to recover much faster. Now, this entire bailout of the financial industry accounted to about $200 billion by the Federal Reserve Bank. And actually, even to this day, not all of these payments were recouped by the Federal Reserve Bank. So this was a really major event. And so again, just going back to this discussion about credit risk, so you see that because in these over-the-counter traded markets, if one institution disappears, if Lehman Brothers goes bankrupt, there might be very severe implications on other institutions, and that leads to these spillover effects and can lead to a very big crisis. Okay, and that's also, there was a lot of discussion about systemic risk of certain financial institutions. Which of these financial institutions have to be more regulated to ensure that such an event will not happen again in the future. Now, if we compare that to exchange traded derivatives, let's suppose Lehman Brothers would enter all their positions with an exchange, well then there would have been much more security, because the exchange would have asked Lehman Brothers to always put down enough money with the exchange to make sure that all the counterparty risk is offset. And in case Lehman Brothers would go bankrupt, then the exchange would actually have enough money to make sure that all the other institutions will get their promised payments and don't just stand there in desperation and not knowing what to do. Now, who are the investors in derivative markets and what do they do? So we broadly have three categories of traders. They're the first type of investors who try to manage risks on their balance sheet. And we also call them hedgers because, well, they want to offset or hedge risks which they are exposed to. Okay, so they basically use derivatives to change the nature of a certain liability which they have on their balance sheet, or perhaps change the nature of a certain asset. And I'm going to give you some examples about this to illustrate exactly what I mean. Then the second type of traders are speculators. And so these guys, they have certain expectations of what's going to happen in the financial market. And that expectation might be quite different of what the overall market thinks. And so they're basically really take a bet. So they really want to gamble. And they use derivatives to get more leverage to be able to get more risky positions. And then the last category called arbitrageurs. These guys, they try to lock in what we call arbitrage profits, or in other words, they try to lock in some risk-free profits which might happen in financial markets due to some mispricing. And I'm going to give you some very specific examples about that as well to illustrate exactly what I mean. So let's start with hedging risks. Hedging risks means you do take some position in derivatives, which actually will imply some risky payoffs in the future, which may look at first like that institution is gambling, but the main point is that that uncertain payoff of that derivative is actually negatively correlated with some uncertain payoff which the institution already has on its balance sheet. And so in that sense, taking these two uncertain payoffs together, they are going to offset each other and making your balance sheet less risky. Going back to that forward contract at the very beginning of this class, where the corporation needs £1 million. If they didn't have the forward contract, then if the pound appreciates, it means it will be more expensive for them to obtain the pounds. If the pound depreciates, it means they have to pay less for the pound. So using the forward contract to lock in that exchange rate helps them to get rid of any of that risk on their balance sheet. Another example would be an option where you as the holder of the option actually have the choice whether you want to buy or sell an underlying asset at a fixed price, but you don't have to. So an option gives you some insurance against an adverse movement in that price. But on the other side, you still can actually capture the upside potential if the price moves in your favor. So if you think about, again, that corporation which needs £1 million, if instead they would, instead of using a forward to fix the exchange rate, they maybe would purchase an option which tells them, if you want, you can buy £1 million at 1.55 US dollar per pound, but you don't have to. Well, then if the pound actually appreciates, they're gonna use that option to obtain the pounds at that relatively low exchange rate. But if the pound depreciates, they would say, well, you know what, I'm not gonna use my option, I'm just gonna get the pound from the open market. Okay, and so in that sense, the option would give them an insurance rather than just fixing the price. So let me give you some more specific examples. So I already talked a little bit about the firm which needs foreign currency to do some business and therefore uses this foreign exchange derivative to hedge its risk. The second example would be an airline which needs to buy jet fuel when it operates its plane, and typically it sells all the airplane tickets beforehand, before they actually fly. So there's this time lag. And so an airline may find it useful from the time where they sold all their tickets until they actually fly, fix the prices of the fuel which they need to buy, and therefore trade in oil derivatives to do that. Then the third example would be a stock trader who maybe is very good at identifying stocks which are underpriced, but he may not be very good to figure out when the overall market may increase or decrease. And so what he may want to use is some derivatives written on an entire stock market index to hedge all the market risk, while he still takes bets on the undervaluation of certain stocks. The fourth example would be a producer of electricity. So these guys are typically exposed to risks in weather conditions. So if temperatures are very hot in Hong Kong, then electricity producers know people are going to use their air conditioning a lot. And so demand for electricity will be very high. On the other side, if the weather is very cold in Hong Kong in the winter, they also know that people will turn on their heating much more. And again, demand for electricity is high. But what electricity companies do not like is very moderate temperatures where people do not turn on either air conditioning or heating. And so what they may want to do, since they are exposed to these temperature risks or weather risks, they may want to trade in derivatives which are written on the current temperature in their location where they sell electricity to basically hedge these risks. So the derivative contract would give them some positive payoff if temperatures are moderate. On the other side, they would give up some payoffs if temperatures are either very high or very low. And finally, the example which we have here is a farmer or a holiday resort or maybe a theme park. All of them are going to depend on the weather. So for the farmer, it is important that the weather is favorable so that he can harvest a lot of whatever fruits or vegetables he plants. The holiday resorts rely on good weather so that a lot of tourists come, and so do theme parks. So these guys may all find it very useful to trade in weather derivatives where they do get some payoffs if the weather's not so much in their favor. Let's look at one very specific example of a farmer who produces corn. And let's say you, the farmer, expect to harvest 20,000 bushels, that's 500 metric tons, or about a field size of 125 acres. And you expect to harvest that corn in December. And of course, once you harvest it, you want to sell that corn. Let's suppose that the current price of corn is $5.63 per bushel. And you know that on the Chicago Mercantile Exchange, you can actually trade corn futures, or equivalent to forward contracts, to lock in the price at which you can buy or sell corn at the future date, or in particular with a maturity in December. One contract is always written on 5,000 bushels of corn. to trade in the future. And let's say the current futures price of a contract with maturity in December is $5.24 per bushel of corn, or meaning for 5,000 bushels, that's $26,200 per contract. Why does the farmer actually want to consider to trade in these corn futures contracts? Well, the problem is that corn prices are volatile, okay? So currently, the corn price is $5.63, but maybe in December that corn price may plummet to maybe just $4.50. And if that happens, then the 20,000 bushels of corn which the farmer is going to harvest is going to be worth much less than what he was hoping, and that would be really bad for business. So he can use corn futures to basically get rid of that risk by locking in the price at which he wants to sell his corn. So the first question here, why would you consider to trade the futures market? We already mentioned that corn prices are volatile. The farmer may not want to take that risk, and of course you want to focus on his main skill, which is farming and not predicting prices. So what position should he take in the futures market? Should it be a long or a short position, and how many contracts? Well, think about that. He wants to sell 20,000 bushels of corn in December. So he's afraid that the price of corn may drop. So he needs to get some payoff from these futures contracts if the corn prices drop. How does he get a payoff from the futures contract if corn prices drop? Well, he's going to get that if he short sells contracts. Why is that? Well, by short selling, you lock in a price at which you are allowed to sell corn. And that means if the price of corn drops, then you can deliver corn, which is relatively cheap, and get then the relatively high fixed price, and therefore you make a profit from these futures contracts. On the other side also, if you think about futures contract, well, the short position allows you to lock in the price at which you sell, and the farmer actually has corn which he wants to sell. Well, then naturally short selling is the choice, the way to go, right? So he has something which he produces and wants to deliver. He wants the fixed price for it. How many contracts? So each contract is written for 50,000 bushels of corn. So that means if you want to hedge an exposure of 20,000 bushels of corn, that means he needs 4 contracts. Now, of course, there might be some uncertainty whether he can actually produce the expected 20,000 bushels of corn. That may again depend on the weather conditions between now and the harvest time. That might be an additional risk. In this example, we're just going to assume that away, but of course the farmer could trade in some derivatives written on the weather to also hedge away that risk. Okay. So now let's go back. So if he short sells 4 future contracts, that means he basically promised that he will deliver 20,000 bushels of corn and receives $5.24 per bushel, or a total of $104,800 for the entire harvest. Now, let's separate the payoff between the futures position and the actual money which he receives from selling corn. Why do we want to do that? Because in reality, typically, the farmer would not deliver the corn to the actual party with whom he signs that futures contract. In reality, typically, the farmer would just sell the corn on his local marketplace. And on the other side, he would just take some cash settlement in the futures market, which if you're in the US, it would be the Chicago Mercantile Exchange. Okay. So therefore, let's look at the 2 different payoffs separately. Let's focus first on the futures position. How much does this farmer who short sells the 4 contracts actually receive from his short futures position in December if the price of corn drops to $3 per bushel? And then afterwards, you're also going to look at all these other realization in corn prices. So if the corn price realizes at $3 per bushel, again, in the short position, you agree that you will deliver 20,000 bushels of corn. So 20,000 bushels are now worth $3 times 20,000, that's worth $60,000. So you have to deliver something worth $60,000. On the other side, you have locked in the price of $104,800, which you will receive. So that means your payoff is going to be the $104,800 minus the value of the thing which you have promised to deliver of $60,000. That nets a gain of $44,800. So you see, the price of corn has dropped below the futures price which you lock in, and that's going to give you a positive payoff as the short position. Okay. Now again, if the farmer had that futures position, in reality, typically what would happen is that the offsetting long position would just transfer $44,800 to that farmer, to that short position. And he's just going to receive that cash. And then afterwards, the farmer will go to the local market, sell his corn at $3, and then calculate his overall profit, which he gets. Okay, but we'll add to that in the next slide. What if the corn price turns out to be $4.50? Well, now the 20,000 bushels which he has to deliver in December is going to be worth 20,000 times 4.5, which is $90,000. Again, he was promised to receive the fixed futures price of $104,800. So the difference is a gain of $14,800. So again, the offsetting long position will transfer $14,800 to the farmer who has that short position in the futures. And you can go through all these examples with all these different corn prices. Let's look just at the other extreme, where the corn price increases a lot to $8. In this case, the farmer has a short position. Again, what he has to deliver is actually worth $8 times 20,000, which is $160,000. On the other side, again, he was promised to receive $104,800. So that means now he has actually a loss of $55,200. So in this case, the Chicago Mercantile Exchange would require that farmer, that short position, to pay $55,200 to the other offsetting long position. You see that depending on the corn prices, the payoff in that futures market is actually quite risky. If the corn prices drop, the farmer may make quite a lot of money. If the corn prices increases, he may actually incur quite large losses. So why exactly did the farmer want to agree to get this kind of risky payoff? Well, the idea is that that payoff is exactly offsetting the profits which he receives by selling the corn in the local market, and therefore will eliminate the risk which he is exposed to. So think about the farmer produces the 20,000 bushels of corn. It is now December. He sells that in the local market. Now you can look at all these different prices from before. Let's suppose the corn price is only $3. Then he will receive in the local market $3 times 20,000, or he gets cash of $60,000. Now, if I combine that with my payoff of $44,800 from the futures market, that gives me an overall payoff as a farmer of $104,800. Okay. Similar, if the corn prices realizes to be $4.5, if this farmer sells the 20,000 bushels in the local market, that means he will yield a payoff of $90,000 for the corn which he sells. And combining that again with the payoff he received in the futures market of $14,800 in this scenario, that will give an overall payoff of $104,800. And you can go through all these different examples of realizations in corn price of $5, $5.5, $6, $6.5, or let's say look at $8. So for the case of $8, selling corn in the local market yields 160,000, but we knew that through the Chicago Mercantile Exchange, we lost $55,200. Again, adding both up will yield an overall payoff of $104,800. So what do we see here? By combining futures payoffs with the actual payoffs from selling the physical corn in the local market, will always add up exactly to the same payoff of $104,800. Okay, and that's exactly the beauty about this hedging example. The risky revenues from selling corn in the local market exactly offsets the risky payoffs which I get from trading in the futures market in the Chicago Mercantile Exchange. Now, is it a big surprise that you get $104,800? Well, not really, because the futures contract was actually designed in a way where you say, well, me as a short position, I will deliver the 20,000 bushels and receive a fixed price of $104,800. That's exactly what we're going to get by adding up payoffs from the futures contract and from selling in the local market. Okay, so this is kind of the perfect hedging example which you can obtain. Let's move on to the second categories of traders. These are the speculators. So again, these guys want to gamble in the market and they want to use derivatives to basically take on more risk or lever up their gamble position. So let's suppose you have the view that gold prices are going to increase very soon. And in particular, you think gold prices go up a lot, but the market does not think that that will happen. Okay, so you actually disagree with the market. So one approach which you can take is you can go out and just purchase gold in the spot market. Okay, so that means you pay cash and you physically get gold, you hold on to it, then after a few days you hope that you are right and gold prices increase a lot, you sell them again in the market and you get a handsome profit. Now, this is nice and good, but the big problem is you need quite a lot of money up front to invest in gold and take that gamble. Now, a different approach would be to use a derivatives written on gold. So in particular, think about entering a long position in a forward or futures contract to lock in the price of gold in just a few days. Okay, so what happens with this approach? So when you enter the long position in the forward contract, if it is a forward contract which is over the counter traded, then you may not even have to pay anything up front. If you sign a futures contract which is traded on exchange, then you maybe have to deposit some money in a margin account, which serves as collateral in case the position moves against you. But in any case, the upfront payment is going to be much less than if you purchase a bunch of gold. Okay. Now, what happens if the price of gold actually increases after a few days? Well, if you have the long position, you have agreed to pay the fixed forward or futures price. But if the price of the actual gold increases a lot, then this gold is worth much more and you're going to get a very high payoff. Okay. So in this sense, you can achieve a very high payoff with a long position in a forward or futures by putting down very little money up front. Or in other words, you can lever up your position quite a lot and take on much more risk than if you have to put down a lot of money and buy gold physically. Now, of course, levering up and using these derivatives to take on much more risk doesn't just mean that you can get much more future payoffs by putting down very little money, but it also implies that you can actually lose much more money in the future. Now let's move on to the last category of traders. These are the arbitrageurs. And let's start with the definition of an arbitrage strategy. So an arbitrage is a strategy that generates today or in the future a positive payoff, so meaning you receive money with some non-zero probability, and for sure you're never going to have a liability, or for sure you're never going to have to pay anything or have a negative payoff. So in other words, what does it mean? It means you get money for free. The simplest example we can come up with is two markets, market A and market B. Both of them trade gold. In one market, 1 ounce of gold is traded for $1,640. In the second market, 1 ounce of gold is traded for $1,630. And let's assume that you can buy and sell as much gold as you want. These prices don't change, and you can instantly travel without incurring any costs between these markets and trade. Okay, so what's the obvious strategy to do? Well, you're going to buy gold in the market where it's cheaper, so that's market B. You pay $1,630 per ounce. You bring it over to market A, and you sell it at a higher price of $1,640, and you pocket in this profit of $10 without having any risks. Okay, and of course you would lever that up. You would not just do it for 1 ounce, but you may do it for basically an infinite many ounces of gold, and basically you get infinitely rich. So this is, of course, a very simplified example. The next thing I want to look at is something which is a little bit more likely to be observed in financial markets and a little bit more interesting. So let's suppose that the current stock price of Apple is $571.50. Let's suppose Apple has a cap M beta, so there's a market risk exposure of 0.93. Which will imply that the expected return is 7.5%, or in other words, you expect that Apple stock price to increase from $571.50 to $614 after 1 year. And let's just assume that Apple doesn't pay any dividends during that 1 year. Now, suppose that you can enter a forward contract to buy or sell, so meaning either taking long or short position of 1,000 shares of Apple for a fixed price of $600,000 in 1 year time. Or in other words, lock in to trade each Apple share for $600. Now, let's also suppose that the 1 year risk-free rate offered by a bank is 1%, and you can either lend money at 1% or you can borrow money from the bank at 1% interest. Okay. Now the basic question is there an arbitrage opportunity, and if so, what would you do? At this point of the video, I would recommend you to pause for a minute and write it down by yourself and try to figure out how to get an arbitrage, so how to lock in a risk-free profit. Now, the first thing which you may consider is, well, since I expect Apple price to be on $614 after 1 year, well, is it an arbitrage to take a long position in that forward contract where I can lock in to buy 1,000 shares for $600,000 and then I wait 1 year, and since I expect them to be worth $614 a piece or $614,000 for all 1,000 shares. If I buy them at $600,000 and I expect them to be worth $614,000, then I basically expect to make $14,000. Well, is this an arbitrage strategy? Well, not quite. Why not? Well, even though it may be attractive because you expect to get $14,000, it is not risk-free, right? So there might be a probability that this Apple stock drops below $600 a piece. And in that case, if I have locked myself in to pay $600,000 for 1,000 Apple shares, and the price, let's say, is worth only $590, well, then I would lose $10,000. Okay? So it's not risk-free, and therefore it's not an arbitrage. So then how can we actually get an arbitrage profit? So let me go to my virtual whiteboard over here and try to write that down step by step. In particular, I want to draw like a timeline where we say today is t equals to 0, and in that future we have t equals to 1 year. Okay, so 1 year later. Now, in our question, we know that the current price of Apple is $571.50. So we can write that down over here as 0 is $571.50. Okay. Then the second thing we know is that there is a risk-free rate to borrow or lend money at 1%. Okay. The risk-free rate is 1%. And the last thing we know is we can sign a forward contract to buy or sell shares at a forward price of $600,000. Okay, so the forward price, and let me just write it down per share, for at maturity in 1 year, the forward price you lock in today is $600 per share. Okay, and it's written on 1,000 shares. So let me propose the following strategy. Today, I buy 1,000 shares of Apple. Okay, what does this cost me? What's the cash flow? It's going to be minus $571 per share times 1,000. So $571,500. That's the cash flow which I get today. And then in 1 year, I'm going to receive 1,000 shares times whatever the price is per share at time 1 year. Okay, that's S1, that's uncertain. It might be 600, it might be 614, it might be 620, or it might be something low like 590. Okay, we don't know what it is. It's risky. Now, because there is a risk, what I can do is I can use the forward contract to lock in the price at which I sell them. How do I do that? So I sign a short position in the forward. And that today means I have a 0 cash flow, so it doesn't cost me anything to write that short position contract. And in the future, I will receive the forward price of $600,000. And I do have to deliver the 1,000 Apple shares, which are worth 1,000 shares times whatever the price is of the Apple share. Now you'll see already if I add up these two things, that risk of the Apple share, that will just drop out. Okay, this thing will cancel out, and so all that uncertainty is gone. So basically, I buy the Apple shares today and I sell them in the future, but I sell them through that forward contract, so I know exactly how much money I will receive for these 1,000 shares. Now, it's not yet an arbitrage, because in an arbitrage, by definition, I should never have a negative cash flow. But right now, I still have a negative cash flow at time 0 because I bought these Apple shares. So what can I do here? Well, I can go to the bank and I can ask the bank to borrow some money from them to finance the purchase of the Apple shares. So I would borrow exactly these $571,500 from the bank, so that I have enough money to buy the Apple shares. Now, after 1 year, I have to pay back. So negative cash flow is $571,500 plus interest. And so how do I do that? So I multiply by 1 plus the interest rate of 1%. And so that is equal to minus $577,215. Adding up cash flows, at time 0, my cash flow is going to be exactly $0. So it doesn't cost me anything to enter these positions. And in the future, well, I get that fixed price of $600,000 through the forward contract by delivering the Apple shares. And again, there's no risk because, well, I did hold on to these Apple shares so that I can just deliver them in the forward. And then I just have to pay back the money to the bank, which I know exactly how much it is. And so the cash flow today will be $22,785. Okay. Now this is an arbitrage. I have 0 cost today to enter that strategy, and I get for sure a payoff of $22,785 in the future. Now, if you go to the next slide, you basically also see an arbitrage strategy. So this one is slightly different than what I wrote on my virtual whiteboard. Here, what I do is instead of borrowing just enough money to buy the Apple shares, I will actually borrow a little bit more. And why do I borrow $594,000 at 1% interest? Well, this amount means that in the future, when I have to pay back the money plus interest, it will be exactly $600,000. And why do I want this to be exactly $600,000? Well, because that's the money which I will get through the forward contract. Okay, so slightly different to what I did on the board. Here I borrow slightly more money, but the other 2 positions are exactly the same. I buy 1,000 shares of Apple, cost me $571,500. I take that short position in the forward contract, which means that in the future, I will have to deliver Apple shares and get that fixed forward price of $600,000. So what's the cash flow today? So I'm going to get money from the bank. I have to pay money to buy Apple shares. Short position in the forward contract has a 0 cash flow. That means today my cash flow is going to be $22,500. What's the cash flow in 1 year? So I have to deliver 1,000 shares of Apple to receive my forward price of $600,000. That's because of my short position in the forward contract. That's no problem for me because I did buy the Apple shares, and so I have them. I can deliver them without risk. And on the other side, again, I had to pay back the borrowed money plus interest, which is $600,000. So that means receiving $600,000, paying $600,000 gives a 0 cash flow for sure in 1 year time. Again, there is no risk because it doesn't matter how much an Apple share is worth. I have already locked in through my short position in the forward contract the price at which I sell them. Now, what's the difference between this solution and the one I have on the whiteboard? So here I get $0 in the future, and I get $22,500 at the initial point. On the blackboard, I had $0 today and get $22,785 in the future. So at first glance, you may say, well, the thing I wrote on the whiteboard looks actually more attractive because, well, here the payoff was only $22,500. Here it's $22,785. Well, how come? What is the difference? Well, the difference is the timing when you get the cash flow. Here you get it after 1 year. If I would actually look at the present value of that cash flow back at time 0, then I would have to discount that by the risk-free rate. So let's take this $22,785, discounted by the risk-free rate. So 1 plus 1%. Well, that turns out to be exactly $22,500, which is the same as what I have here in my lecture notes. Okay, so these strategies are actually equivalent. The only difference is that you get your arbitrage profit at a different point in time. it doesn't actually matter which strategy you implement, you do get an arbitrage profit in both cases. Note that if you plug in, sometimes maybe there might be a rounding error, and so you may not get exactly the same value. Don't worry about small discrepancies. Again, it's just due to some rounding errors when you do calculations. So this will lead us to the principle of asset pricing and the main concept of this entire course. We basically want to always find the correct price of an asset by imposing that there is no arbitrage to be made in financial markets. What's the idea? Well, the idea is that we have a lot of financial institutions out there who are eager to find these risk-free profits to be made. And so as soon as an arbitrage profit arises, they will step in very quickly, trade a lot of times until demand and supply adjust prices, and these arbitrage profits disappear. So if we are an investor who doesn't trade very quickly, then basically we could say, well, it is safe to assume that there's no arbitrage opportunity out there. Or in other words, if we are a trader and we want to try to figure out what is the fair value of an asset, then we can find that fair value by imposing a no arbitrage condition. Okay. So in more detail, what does it mean? Well, if you have two investment strategies which have exactly the same payoffs in every possible state of the world in the future, so no matter what happens in the future, well, then it must be that they have exactly the same price today. So again, how does this help us to actually find the fair value of a certain financial contract? Well, basically we can say, look, we have a financial contract, we know how much payoff it's going to get in the future. Then what you try to find is some other strategy which exactly replicates these payoffs of that financial contract. And then by no arbitrage, you can say, well, then the initial price of that financial contract has to be the same as that replicating strategy. Another way to use this no arbitrage concept is to get some other bounds on prices between strategies. So let's imagine you have some strategy A, which always pays off more in the future than strategy B. Then you know that it has to be the case that strategy A must have a higher price than strategy B. Okay, otherwise there's always a way to make money for free, or in other words, there's an arbitrage opportunity. Why is that? Well, let's suppose that strategy A had a lower price than strategy B. Well, then I would always want to buy strategy A and sell strategy B to get initially some money. And then in the future, if I have strategy A and sell strategy B, I know I never have a liability because A always gives me higher payoff than what I own by selling strategy B. Recall that the payoff of a derivative always depends on the payoff of an underlying asset. And so therefore, you can always use a derivative, an underlying asset, and the risk-free asset to build a strategy which earns nothing in the future, and therefore, if there is no arbitrage, must cost nothing today. So this is exactly the example which we had before with the Apple shares. Here, we took positions in Apple shares, we took positions in the forward contract, and we did take a position in the risk-free asset, such that there is for sure no payoff in the future. Now, here there is an arbitrage, that's why we had a payoff today. But if there was no arbitrage, that payoff should be zero, or that strategy of combining the three things together should have a zero price or a zero cost. Okay? So why is that useful? Well, because it helps us to recover the price of the derivative. It helps us to figure out what should be that forward price for the Apple shares so that there is no arbitrage profit in the market. Okay? So in other words, we can recover the fair value of a derivative from the price of the underlying asset and the risk-free interest rate. And so in our course, we're going to use this concept over and over again. And so therefore, this is really the heart of what you will learn in this course. Okay, so make sure you really understand this principle of asset pricing, this concept of arbitrage or imposing a no arbitrage condition, and that you understand how to make an arbitrage profit, if I will give you an example as with that Apple stock. Now let's go to a little bit more fun part of that introduction chapter. Let's look at the dangers of derivative trading. So there are really two things which can happen. The first one is if you tell a trader that he is supposed to hedge certain risks of your institution, and he maybe starts to get bored or he wants to earn more money, and instead of hedging risks, he starts to gamble. So he switches from being a hedger to being a speculator. And this is, of course, not a good thing, because you do not want your risk management department to start gambling. Okay. The second problem which can arise, and is a little bit more subtle, are limits to arbitrage, which are typically financial constraints or liquidity risks. I don't want to say too much about this here. We're going to talk about some case studies in later chapters and discuss them in a lot of depth in the class. And in particular, we're going to talk about long-term capital management, which had faced certain financial constraints, and because of that went bankrupt. And we talk about an example of a company called Metallgesellschaft, where they were facing some liquidity risks and they lost a lot of money from their actually otherwise good hedging positions. Okay, but the basic idea is that you identify a good strategy, and it might be a good strategy to hedge certain risks, or it may be you identify a strategy to make an arbitrage profit. But the problem is you're not able to keep your position until to the maturity date of your derivative, and therefore you're not able to pocket in these arbitrage profits or go all the way through with your hedging strategy. Why is that? Well, it could be that you take certain position in the derivative markets, which require you to post some collateral if the market temporarily moves against you. And maybe you just don't have enough money available to post this collateral anymore, and therefore you're forced to exit your position before you can pocket in arbitrage profit or complete your hedging position. And that's, of course, a very bad thing, because of these temporary price movements. You may lose a lot of money and then be fully exposed to risks which you actually didn't want to. But again, as I said, we're going to study these cases in more detail later. Let me illustrate the first example of a trader moving from being a hedger or arbitrageur to becoming a speculator. And this is kind of like the showcase example when you talk about these issues in financial markets. And that's an example about a very old bank called Barings Bank. That bank was more than 100 years old, and they employed a trader called Nick Leeson, who is actually from Ireland, but they sent him to their Singapore office, which at that time was very tiny. It basically just consisted of him and some support staff, which were basically just under his supervision. And they sent Nick Leeson to the Singapore office to trade Nikkei 225 futures. So these are futures written on the Japanese stock market. The reason why he had to trade these futures were twofold. On one side, they wanted him to look out for arbitrage opportunities, kind of similar like our example with the Apple shares. And as soon as one of these opportunities arises, he should lock them in and make some risk-free profits. And on the other side, he was supposed to just trade as a broker for some of the clients of Barings Bank, okay, and pocket in some brokerage fees. Now, the problem is that at one point he made some losses, And he didn't want to show these losses to the headquarters back in London, and therefore started covering them up and tried to actually earn these losses back by speculating in the market. It is not terribly important why he made these losses to begin with. Some people say that he was just gambling because he was bored. Other people said because he wanted to attract some big clients as a broker, he gave them a very good deal, and that incurred some losses. And but he did that because he really wanted that big client to stay with him in the future. But nevertheless, he didn't want to report these losses back to the headquarters. Now, what we know for sure is that at the point where he made the losses, he didn't report them to accounting, and instead he started to speculate in the Nikkei 225 futures market and took some big bets. In particular, he took some long positions and was hoping that the Nikkei 225 increases a lot so that he can earn that money back and cover up his losses. And then, you know, the headquarters would never find out and probably also would never care because, well, the money would be back in the accounts and everyone would be happy. The problem was the market moved against him. He made bigger losses. And so he started to speculate even more and started an even bigger cover up. The big problem for him was that he took eventually very big speculative positions and the Japanese stock market dropped by a very big amount. And so at this time, he incurred losses in his futures trading position of almost $1 billion US, which was a whole lot of money in 1995 and actually was enough money to force Barings Bank into bankruptcy. So basically, this one trader who was responsible for a relatively small market and was sitting alone in Singapore brought a very old bank, which again, at that time, you could have compared to something like Goldman Sachs, brought down that entire bank, okay, with just two big trades, which he was actually not authorized to do. Now, at that time, Nick Leeson, of course, realized he did something illegal because he was covering up losses and he was trading bigger positions than what he was supposed to. And the natural thing to do was he tried to escape. And especially because, you know, prisons in Singapore are not so nice. So he tried to make his way back to Europe and in particular back to Ireland where he was from. The problem was that he made it on the plane, but had to change the plane in Frankfurt, Germany, where the police captured him before he could make his way onto the plane to Ireland. And Germany at the time didn't extradite him to Ireland, but sent him all the way back to Singapore. And so he had to go there to court and was then sentenced to 6.5 years in prison. To make things even worse, while he was in prison, his wife actually divorced him and he got cancer. On the upside, that cut his prison sentence a little bit short because of health concern. They released him early, then he could go back to Ireland, and lucky for him, he actually fully recovered of the cancer. And nowadays, he is actually touring the world and gives lectures on financial fraud and what companies should do to avoid situations as what happened to Barings Bank. Now, of course, the owners of Barings Bank are not quite happy about that because Nick Leeson now travels around, makes quite a lot of money by giving these public lectures, while Barings Bank really lost a fortune because of this disastrous and fraudulent trades which he made back in 1995. To be fair, the bankruptcy law in England is actually kind of stringent. Much worse than, for example, in the US. So Nick Leeson actually owed Barings Bank a lot of money in a private lawsuit. And so he actually still has to make payments to Barings Bank to this day. So it's not like that he's actually swimming in money from his lectures, but he does have to make payments to them as a compensation. Now, you would think that, you know, 1995, it's a long time ago, it's an isolated case, but actually there were more of the similar types of frauds out there, and actually quite shockingly a lot of similar incidents, and some of them actually quite recent. So in particular in the recent financial crisis, a few similar cases like the one from Nick Leeson were uncovered, and big banks lost a lot of money. I have here 2 slides with similar examples like the one of Nick Leeson. I just want to handpick a few of these cases and provide a little bit more details. The first case I want to look at is Hillary Clinton's trades in cattle futures. And back in 1979, this case never went to court, and there was never proven that Hillary Clinton did any fraud. Nevertheless, it is known as one of the controversies in derivative markets. So back in 1979, Hillary Clinton was a housewife. Her husband, Bill Clinton, was still an attorney making less than $100,000 a year. And at that time, she started trading on her own accounts with a few $1,000s in cattle futures. And after just a few months, she earned $100,000. And after that, she actually exited the market and she never traded again. And so people were a little bit suspicious about how could this housewife who didn't know anything professionally about financial markets and also didn't know anything about cattle markets per se, how was she able to make so much money in trading cattle futures? She was saying that she had this friend who was trading in cattle futures professionally, and knew also this broker in cattle futures, and she said she basically just followed their advice, and that's how she made a lot of money. To the reason why she stopped trading after she made all these profits, she always said that, well, afterwards she had children and she just didn't have the time and energy to trade any more in these risky cattle futures. Okay, it's a plausible explanation, but people were still kept wondering. So here's the theory which some people had. At the time, since her husband Bill Clinton was an attorney, it is not unimaginable that maybe someone wanted to transfer some money to her husband. And of course, how do you do that? Well, you cannot just drop in and give them $100,000. That would raise a lot of suspicion, and a bribery scandal would be pretty bad. And no party actually wants to risk that. So how could you do that in kind of a more legal way or in a less obvious way? Well, people are thinking, how about if the wife of Bill Clinton, Hillary Clinton, goes to this cattle futures broker, and the party who actually would like to transfer a bunch of money to the Clintons goes to the same broker, and now they start to get involved in a few cattle future trades. And so what the broker would do is he would open at the same time some long and some short positions. And if cattle future prices increase, then he would go back into the books and write that, well, Hillary Clinton took the long position and that other party took the short position. And in a very legal way, now the other party will transfer some money to Hillary Clinton. If on the other side, cattle futures prices drop, the broker could go back into the accounts and write Hillary Clinton took the short position while the other party took the long position. And again, in a very legal way, you have a transfer from that other party to the Clintons. Now, of course, gathering enough evidence to convince a court that there was actually a bribery case like this is very hard, because again, this entire transaction in the books looks very legal, and you really would have to get some witnesses who would testify that this is really what was going on. So in that sense, this is all speculation. We have no idea whether someone actually bribed the Clintons or whether Hillary Clinton was just incredibly lucky and made a bunch of money. All we can say is there is this potential hypothesis which people think might have happened. But again, there's never going to be any proof. And in that sense, we should always assume that the Clintons are still innocent. The next case, Hammersmith and Fulham, that's quite interesting because that's a district in the city of London in the UK. And a lot of districts, they do borrow money for many different projects which they are implementing. And from time to time, they borrow money at some flexible or floating interest rates. And because they want to get rid of risks in market movements in these interest rates, they use certain interest rate derivatives to hedge these risks. So there's nothing unusual about that. What happened with Hammersmith and Fulham is that the treasurers of these districts started to trade much more aggressive in these interest rate derivative markets, in particular interest rate swaps, than what could have been justified by the amount they were borrowing money in the market. Okay, so in that sense, they were clearly speculating and not just hedging risks which they had on their balance sheet. And at some point in 1989, they actually booked losses for $600 million. At that time, what happened is that they couldn't actually make these payments, and Hammersmith and Fulham didn't want to declare bankruptcy. So what happens is they went to the court and they tried to argue that these contracts which the treasurer entered were actually not legal. The treasurer was not allowed to enter these contracts with their counterparties, which are big banks, and therefore there was no obligation to pay the 600 millions to these banks. That's of course very unfortunate for these big banks, because most of them would hedge in turn their exposure to these interest rate derivatives and try to just earn a small spread. Now, because they didn't receive the $600 million from Hammersmith and Fulham, that made basically that these losses were now borne with the banks. Okay, but what do you want to do if the government rules that these contracts were not legal, and therefore the Hammersmith and Fulham districts do not owe this money to the banks? There's nothing the banks can do. We have a similar case actually with Orange County, which is in California, where the treasurer also started speculating a lot in interest rate derivatives and even lost $2 billion just a few years later. In that case, interestingly, Orange County actually defaulted. There was no judgment that these contracts were not legal or anything like that. So here you can just see a little bit with these different jurisdictions, there might be different judgments, and these contracts may be more or less enforceable depending on where you trade. This is quite an interesting example, because when you trade with a government organization, you just have to bear in mind that there might be additional risks than just normal risks of trading with another institution. In this case, it is really kind of a political risk, because the government eventually wiggled his way out of paying the debts to the banks in Hammersmith and Fulham. Okay. Metallgesellschaft, we're going to talk about this case later during our course. Basically, they tried to hedge their exposure in oil markets. They entered some positions in oil futures markets, but at some point they ran out of liquidity and booked losses of $1.3 million and were forced to exit these hedging positions too early. Okay, but again, we're going to talk about that in more detail later. Another one which I want to mention is these examples of Gibson Greetings and Procter & Gamble, which traded both with Bankers Trust. In these cases, Bankers Trust was selling some complicated derivatives to Gibson Greetings and Procter & Gamble, and basically made a lot of money in terms of fees from these two clients. And it turned out that Procter & Gamble and both Gibbs and Greetings didn't really understand the contracts which they bought because they didn't have the financial expertise. And they made the case that actually Bankers Trust were kind of exploiting their position as their broker to really rip them off, selling them products which they didn't really need and which were not suitable for them, and just charge them a very high fee for these products. LTCM, long-term capital management, that was a very big hedge fund in the 1990s, and they traded in a lot of different derivatives, and at some point they did hit certain financial constraints and were forced to liquidate a lot of positions and very big losses and went bankrupt. And this is kind of the very nice example of limits to arbitrage. And we're going to talk actually about a specific case of long-term capital management later in the course. So I'm going to defer that until later. The example of Enron over here. So Enron was considered to be very innovative in financial markets by introducing new derivatives and special purpose entities. But really kind of their big losses were due to some accounting frauds. And, you know, probably a lot of that was possible because people didn't really understand what they were doing at the time. So they were kind of able to cook the books and pretended that they made big gains, even though it was all just an accounting fraud. I think the more interesting thing to look at is the subprime mortgage and the global financial crisis in 2007, 8, and 9. And for that, I want to just talk very briefly a little bit about mortgage-backed securities. And for that, I want to switch again over to my virtual whiteboard. So mortgage-backed securities, basically the idea is that if you issue a mortgage to someone who buys a house and you want to sell this mortgage to another institution. So let's say Bank of America issues initially that mortgage, lends money to someone to buy a house, and then Bank of America wants to sell that mortgage, let's say, to HSBC. Then if you do that trade, HSBC would have to investigate a lot and figure out, so who is that person who bought that house and got that mortgage from Bank of America? What is his job? How stable is his income? How big is the mortgage compared to the home price? In which area is that house? And, you know, what kind of, how much can that house price fluctuate, and so forth. So it would need quite a lot of due diligence to figure out what is the true value of that mortgage. And so that may be actually quite involved and imply quite high transaction costs for a Bank of America to sell that mortgage to HSBC. So the idea of mortgage-backed securities is that you would say, well, Bank of America actually issues thousands of mortgages for thousands of different people out there who buy houses. And how about if you take many of these mortgages together and put them all into one big pool and create a security which adds payoffs from all the mortgage payments which are made. Now, some of these mortgages, people may default and don't make their interest payments, and there will be a foreclosure and the house is sold and etc. But a big other fraction of people will just make the regular interest payments, and eventually you can get for the entire pool of mortgages, you can kind of figure out what is on average the return which you can get from all these mortgages together. And a lot of these idiosyncratic risks of, you know, the specific profession someone works in, or whether a house is located in St. Louis or in Chicago or in LA, a lot of these idiosyncratic fluctuations will cancel out. So it's kind of like a diversified portfolio of lending to homeowners. Again, so that's kind of the idea of this mortgage-backed security, that you pool together a lot of mortgages, and then you don't need to know a lot of the specificities about these different mortgages And in turn, you can just kind of assume that there are some aggregate risk variables which matter and generate the income. Okay, so again, just to illustrate that here, you would think of there are all these individual parties, people, borrower A, B, C, and so forth. They all buy a house and they all need a mortgage. They borrow money from a financial institution. Okay, so we have here a bank. And what they do is they group together all these mortgages, okay, and they put it into one security, okay, and this is the mortgage-backed security. And again, we don't need to know the details about all these borrowers anymore. We only need to know kind of what are the aggregate characteristics of all these mortgages together, which then generate some return. Now, to make things a little bit more complicated, what people did is they sliced up these mortgage-backed securities in different tranches. And you can think of this as kind of like a fountain with kind of a waterfall concept. So you would have a first bucket here on top, and the returns from the mortgage-backed security pour into that bucket. And as soon as it reaches a certain level, then you would fill here some of that more money into the next bucket, okay? And that starts to fill up. And as soon as a certain payout is made in that second bucket, then more money will be paid into a third bucket, okay? Now, if everyone makes their mortgage payments, there's a lot of money around, a lot of returns will be paid out, that first bucket will be fully filled, and investors of that first tranche get their full return. So here's return to first tranche. And after that, the second bucket starts filling up. And if again, everyone makes their payments, that bucket will be filled up and returns will be made to the second tranche. And eventually you will start to fill up that third bucket, and that will determine the return to the third tranche. Now, what is the idea here? The idea is that if some of these people over here start to default, let's say B starts to default, that will reduce the returns a little bit over here in the mortgage-backed security. So reduction in return. But the beauty about these different tranches is that still the first and second tranche will most likely receive all their money, and the one which loses out is the third tranche. Okay, and so this one is the most risky investment. As soon as you have some losses from the mortgages, this translates into some reduction in returns from the mortgage-backed securities. But again, the safest tranche will first receive all the payments, then the second tranche receives its payments, and the first ones which lose out are this third tranche. Okay, so in that sense, the first one over here is safest, then this one is somewhat risky, but really the most risky one is the last one, okay? Because the last one is the one which first has to eat the losses if some of the people don't pay their mortgages. On top of that, with these mortgage-backed securities, what people did is they wrote some insurance contracts on that safest tranche. Okay, over here they wrote insurance contracts, also called CDS or credit default swaps. And the idea was that from the mortgage-backed security, some premium, or from that first tranche, some premium will be paid to some counterparty of the CDS contracts. And in return, if, let's say, a lot of people were to default on their mortgages and these returns are very tiny and some losses would be made even in the first tranche, which is already quite unlikely, then the CDS counterparty would pay some insurance payments to the first tranche. So in that sense, making that first tranche really extremely safe. Now, what happened during the financial crisis is that a lot of that risk was miscalculated. So first of all, of course, when you look at this, it sounds very safe to invest in that first tranche, especially because, first of all, you know that idiosyncratic risks don't matter too much. Only the aggregate risks of defaulting or big house price movement may matter. But even then, the first people who lose money are kind of in the risky tranches, the second risky tranche, and only eventually, if there are really very big losses, then the first tranches will be affected. But even then, you would still have this insurance written by these credit default swaps. So in that sense, a lot of rating agencies said that these are AAA securities. So it's basically as safe as if you would just lend money to, for example, the US government or to any government who is really trustworthy to make repayments of their bonds. Now, what happened during the financial crisis is that there were actually much more defaults in these mortgages than people ever thought is possible. And one of the reasons might be because people just miscalculated the correlation between defaults. So maybe defaults were not just due to some people randomly losing their job, but there was maybe a more systemic reason why a lot of people got laid off. And maybe also house prices systemically dropped and not just in certain neighborhoods. And so this risk was much more aggregate than what people really anticipated. And so much more losses were incurred even in the first tranches, and much more credit risk was actually possible than people were ever thinking. So meaning that these losses were so big that people who wrote these CDS were not able to actually pay that insurance anymore, okay? Another explanation over here is that rating agencies actually had somewhat an incentive to tell people the wrong ratings, to basically inflate their ratings and tell people, yes, these are very safe tranches, even though they were aware that these correlation risks and possible losses of these mortgage-backed securities are much larger. The reason is because the structure of rating agencies is very strange. So basically, rating agencies receive money from the people who ask them to make the rating. And these are the issuers of the mortgage-backed securities. So if a rating agency would give very bad ratings to this mortgage-backed security issuer, then basically the issuer would just say, you know what? I just don't want to hire this rating agency. I'm just going to look for another rating agency which gives me a better rating, and I'm just going to pay these guys. So there were some very perverse incentives in this rating agency industry, and actually still are, that people would go to shop around for the best rating available, and rating agencies would want to earn the business by basically promising very nice ratings to these clients, and in this case, these issuers of the mortgage-backed securities. Sorry about that. Now, An additional problem was that maybe it is not even due to the fact that the correlation of all these defaults between these different home buyers was underestimated because it is some systematic risk, but maybe it is due to the fact because the bank who actually issued all these mortgages, who gave money to person A, B, C, and so forth, maybe these banks didn't do a very good job at screening their lenders. And why is this a very plausible hypothesis? Well, because the bank actually knew that they're not going to bear the risk if these guys going to default, right? Because the bank knew that they can lend money to a guy who is very risky, because they afterwards take that mortgage and pack it into a mortgage-backed security and just sell it off to the financial market. So in that sense, loan officers of that bank over here had really bad incentives to just lend out as much money as possible to people who wanted to buy houses, even if they knew that these guys who borrowed the money to buy houses were extremely risky and very likely to not being able to make payments and will eventually default. Okay, so there's really kind of multiple reasons why these mortgage-backed securities eventually incurred much bigger losses than what people ever anticipated, and why eventually these losses translated into such big losses that not even these insurers were able to pay these investors in the safest and first tranches anymore. Okay, so it's kind of a mix together of many reasons which formed that perfect storm and led to the financial crisis. Okay, and during that financial crisis, tens of billions of dollars were lost, and actually subsequently to the financial crisis, a lot of the big financial institutions did have to pay very big penalties because of some suspected wrongdoing. Okay, so regulators actually went after them and said, look, you guys didn't you guys didn't act in good faith. You issued mortgages which you really should not have issued, and also rating agencies probably gave ratings which they shouldn't have done. Now, interestingly though, is that regulators did fine these financial institutions very big penalties. However, no one actually had to go to jail for all that wrongdoing, which is somewhat interesting because a lot of people lost their homes, lost their jobs, and lost a lot of money because of really something which was, I think, quite clear fraud, and why big financial institutions were fined. And yet no one actually had to go to jail for that. Related to the financial crisis, we also have an example of John Paulson. He is a hedge fund manager, and he basically realized that risks of these mortgage-backed securities are much higher than what other people believed. And he realized that a lot of these initial mortgage holders were about to default, and returns of these mortgage-backed securities are going to be very low. And so what he wanted to do is he wanted to bet against this mortgage-backed security. So he basically wanted to have a short position in these mortgage-backed securities. And the way he did it is he basically said, look, I want to buy some of these CDS contracts. So we have here John Paulson. And he was saying, look, I pay you guys also the premium to get insurance in case mortgage-backed securities default. So he pays a premium and he gets insurance if MBS default or have very low returns. Now, the interesting thing about this is that John Paulson didn't actually buy any mortgage-backed securities. So he basically bought an insurance, even though he wouldn't lose anything if mortgage-backed securities have low returns. So in that sense, it was really a pure speculation and a pure bet that mortgage-backed securities are going to have very low returns. and people default on their mortgages. And it paid out very well for him. He did pay insurance premiums for quite a while, but eventually house prices started to decrease, people started to default on their mortgages, mortgage-backed securities did terrible, and he received very handsome payoffs through the CDS contracts. Notice, because John Paulson didn't actually own any CDS and therefore it's not a true insurance, that's why we also call these empty creditors. So empty creditors are guys who actually buy insurance on something which they are not really exposed to that risk, so for pure speculation reasons. Let me just talk a little bit more about CDS market. So I talked a little bit about it with these mortgage-backed securities, but I want to be a little bit more specific about what CDS really do. CDS means credit default swap. And the idea is the following. So you have someone over here who borrows money. So this is the borrower. And you have over here a lender. So this guy gives money to the borrower. Gives a principal amount. And this guy will pay back that principal eventually and make some interest payments. Okay? Now, the CDS contract is a contract between the lender and the CDS counterparty. So let's call this counterparty. And this is the CDS contract here. Here, the lender will pay some premium, and that counterparty will pay insurance if borrower defaults. Okay? So if the borrower is actually able to make all the interest payments to the lender and pay back the borrowed money, so that principal amount, then this counterparty over here never has to pay anything to the lender, but just collect some premium. But if the borrower over here defaults and doesn't pay some interest payments or fails to pay back the principal amount which was lent by the lender, then the counterparty in the CDS contract would pay some insurance amount to the lender. Okay, and now of course the CDS contract could determine that the insurance insures the full interest plus principal amount, or it could be less money, or, and here's the interesting case, it could be more money than what that lender ever would get from the borrower. And here it becomes interesting, and that's what we call empty creditor. What if the lender buys actually more insurance through CDS than the money which is at stake from potentially losing from default by the borrower? Well, then the lender actually has some incentive and would like that borrower to default because, well, they get more money paid by that counterparty than what they ever will get by the borrower if he doesn't default. Okay, so that can give some weird incentives, and maybe the lender will try to force that borrower into default by maybe not helping him to restructure some debt if that borrower is in financial distress, or maybe there would be some good economic possibilities to help that borrower out of distress. Now, the even more interesting case is if someone signs a CDS contract and pays a premium and receives, so again, this is another counterparty, CDS counterparty. There's another CDS contract. Again, here we have pay insurance if borrower defaults. Now here it becomes interesting. So we can have another counterparty paying a premium to that first counterparty over here. And again, this guy, let's maybe to distinguish them, call this counterparty A and this counterparty B. So A will have to pay B a lump sum or some insurance money if the initial borrower defaults, doesn't make payments anymore to the lender. But actually, B will not incur any losses from that default of the borrower. So this is pure speculation, and B just hopes that the borrower will default. We have actually another case related to CDS, which is Amherst Holding, and they were trading with quite a lot of different big financial institutions, and they made $100 million gain in 2009. So let's go back to our whiteboard where we had the borrower. The borrower got some money from a lender and he has to make interest payments and then also return eventually the principal back to that lender. And then we had here two CDS contracts. One was actually where the lender seeks some insurance, and there is this insurance provider, that counterparty A. Again, they receive some premium and they pay on the other side some insurance to the lender in case that borrower over here is defaulting. And then we said there are these empty creditors. That's the counterparty B over here, which has another CDS contract. Again, these empty creditors pay a premium, and then again, counterparty A pays the insurance payoff if the borrower over here defaults. Again, the idea, why are these empty creditors counterparty B? Well, because they don't actually lose anything if the borrower defaults. Okay, so they just basically backed on that borrower to default. Now, Amherst took actually the position of counterparty A. So they are over here, Amherst, and they were selling insurance premiums to a lot of big financial institutions, and these big financial institutions took that role of counterparty B over here. In this specific case, they wrote a CDS contract on a really bad borrower. So basically everyone agreed that with almost 100% probability that borrower over here is going to default. They're not going to be able to make interest payments anymore, and they're not going to be able to return the principal to the original lender. And therefore, the premium in the CDS contract was really high. The premium was something like 80 to 90 cents out of $1 insurance. And so what Amherst did is they said, well, we are still willing to sign these CDS contracts and we are still willing to sell insurance. They did that for an amount of like $130 million. They provided that insurance to many different financial institutions. So financial institutions said that, well, yes, we are willing to pay 80 or 90 cents on the dollar in premium because we are so certain that these borrowers are going to default. So this is basically a safe bet for us. Now, the clever thing which Amherst did is once they collected all the premiums, which amounted to more than $100 million, they actually provided money to the borrower, and the outstanding loan of that borrower was only of the order of about $27 million. And so they gave money, to the borrower to pay back original loan. Amherst was saying, look, if out of the more than $100 million which we collected in insurance premium, because we provided insurance for about $130 million, out of these collected insurance premiums, we can as well give these $27 million to the borrower over here so that they can satisfy all the remaining payments to the lender. and don't default. And since they don't default, then Amherst doesn't have to pay anything to these financial institutions anymore. Now, of course, the financial institutions were very unhappy about this, and they said, well, that doesn't seem to be legal. That's like a manipulation, because you guys basically only give money to these borrowers so that they don't default, just so that you can get a lot of gains from the CDS contract, so that you don't have to make any payments anymore. And I mean, that's true. Of course, it doesn't seem to be very ethical what they did, but the courts eventually ruled that this is still legal. And so Amherst was fine. They were able to keep almost $100 million in profit. And the financial institutions basically just had to suck up their losses. And then finally, we have two examples, Societe Generale and UBS. These were also traders similar to Nick Leeson, who actually speculated in the Euro stocks 50 futures, and also in the Euro stocks, the DAX and the S&P 500 futures, and lost a bunch of money. The interesting thing is that even as recent as 2008 and 2011, traders were still able to basically take way too big positions in trades which they were not supposed to do, and not report them properly to the back office. And that's even possible in an age where we have electronic trading. So it's not anymore these trader who is far away in a foreign country, and you know, in a time where we didn't really have modern technology and it was difficult to keep track of what Nick Leeson was doing out in Singapore. But here, people were even able to do that with electronic trading systems. And the reason is just because there are certain bugs in these systems. In the case of UBS, it was the case that the back office was only reporting trades once they were formally settled, while a trader was able to take positions and close them again within a matter of a few hours. And so the back office will never know about it until not much later. Okay, so in this case, the trader was able to take very big positions without the back office knowing, and unfortunately, that trader got unlucky and incurred very big losses. In the case of UBS, the trader actually had to go to jail for a few years. So that's actually kind of comparable to what happened to Nick Leeson. And the last example which I want to single out, that's not necessarily anything to do with derivative markets, but it's a very interesting example nevertheless. That's about Bernie Madoff. Bernie Madoff was a very big name in the financial industry. And he was one of the people who actually helped with the modernization of NASDAQ and introduced a lot of electronic trading in markets. And so from that point of view, Madoff was a very trustworthy person, and a lot of people were basically willing to cut him a lot of slack. Okay, so he started at some point his own hedge fund. He basically reported a lot of gains in his hedge funds for many years, and no one actually questioned what he was doing. Okay, so people just kind of trusted him that he was smart and they'd be able to make a lot of profits. Now, his hedge fund was quite interesting because he would only take money from like some big institutions like charities or some very big clients where he knew that they would pour in a lot of money, but are very unlikely to withdraw. Okay, and so in that sense, he was basically able to do whatever he wants with that money, and he could just pretend like he makes a lot of returns on these investments, and people would trust that, yes, probably there's a lot of, he made them a lot of money, but, you know, they never really saw the need to very quickly withdraw that money. So what Bernie Madoff actually did is he just parked the money somewhere, didn't really do anything with it, but he just pretended that he made like every year about 10% returns. Okay. Now, some market participants were wondering how come that Bernie Madoff has several $1 billion under management, but we never see him trade in any markets. Okay, and they were actually sending emails to the U.S. Security Exchange Commission so the SEC, and we're telling them, look, something weird is going on with Bernie Madoff's hedge fund, because no one sees them trade, but apparently they have several $7 billion under management, and apparently they make gains of about 10% every year. Now, the SEC didn't really take that very serious, again, because Bernie Madoff was a very big name, and they basically just swept it under the rug. However, during the financial crisis, some big investors kind of got nervous, even though Bernie Madoff was telling them, look, we are still doing very well, we're still making a lot of profits, don't worry, just leave your money with me. Some of these guys nevertheless got worried and started to withdraw money. And at that point, the entire Ponzi scheme unraveled, because Bernie Madoff was not able to find new investors which would cover all the withdrawals, and he basically had to admit that not enough money was in his fund. So all these gains which he reported were not real, and that money was not around. And at that time, well, obviously, he was accused of fraud. He had to face both civil lawsuits with all the investors. He was eventually sentenced to more than 100 years in prison. And it doesn't really matter, because he's also already like 70 years old, and basically he's gonna spend the rest of his life in prison. Okay. The even sadder realization for him was not just that he spends the rest of his life in prison, but also one of his sons was actually involved in his hedge fund. And when his son got arrested, the son actually committed suicide, which was pretty sad, okay? But just to kind of point out that even a big name in finance, you should be still very diligent and check about what they are doing and not just blindly trust them, okay? So overall, what lessons can we learn from all these examples which I gave you? Well, first of all, I would say, and that's true for finance overall, it's always good to be diversified. Don't put all your eggs in one basket, right? Because if something happens, for example, financial crisis, if you think these first insurance tranches of these mortgage-backed securities are very safe, still, it's maybe not a good idea to put all your money there. But maybe you should invest in many different assets. Second, risks should be always quantified, and risk limits should always be very well defined. And exceeding risk limits should never be acceptable, even if high profits are made in a certain division of your institution. And we should never ignore the risk management even during good times, because markets can always turn around and good times can always turn bad. And if you take very big risks, if you ignore your risk management, you may make very big losses. Moreover, it's important to do scenario analysis and do stress testing. So this typically goes beyond the standard risk metrics. Okay, so standard risk metrics may assume some normal distributions, but stress tests and scenario analysis may actually consider certain crises which are very big jumps in asset values and are outside of these standard models where you assume a normal distribution. So it's important to look at these kind of rare events, how they would affect your institution. Then liquidity risks are important. So sometimes you may think that you actually lock in some arbitrage profits, or you run a very clever hedging strategy, but maybe you're not able to wait until to maturity of these contracts, because you will have to make some very big payments in between, and you just don't have enough cash in your company. And at that point, you might be forced to liquidate and incur very big losses. So liquidity is a very big concern, and we should always be aware of that. Then in our course, we're going to learn a lot about different models, how to find the fair value of a contract. And in turn, if the value of a contract deviates from a model, it would indicate that there is some arbitrage profits. But you should realize that models can actually be wrong. So you should be somewhat conservative and always think about, if there seems to be some mispricing, is there truly a way to make money for free, or might my model just be wrong? And for that, you actually need to understand the assumptions of your model and really how the model works. You should not just plug in numbers into a model and trade accordingly. You should always understand how the model works, okay? In addition, if everyone uses the same model and follows the same strategy, this may also bear its own dangers, because there might be some herding in financial markets, and there might be some very big movements which are not predicted by the model because everyone trades in the same direction. And there are some of these examples, and we'll talk about this a little bit later on when we talk about portfolio insurance and the crash in 1987. Then it is also important that you understand what you're trading. Okay, so thinking about Procter & Gamble and Bankers Trust. So Procter & Gamble obviously didn't have expertise in derivative markets, and they blindly bought products which Bankers Trust were selling them, even though these products were not suitable. So it's generally a bad idea to buy something if you don't really understand it. And on the other side, if you are Bankers Trust and you know your client doesn't understand it, it's not ethical to sell them these products and try to make a big profit off this. And in particular, for that example of Bankers Trust, I mean, I didn't mention this before, but Procter & Gamble and Bankers Trust, there were actually some tapes of phone calls recorded of Bankers Trust where certain traders were actually saying that they knew that Procter & Gamble didn't understand what they're doing, and they basically can just take their money, and that definitely is a wrong thing to do. As a manager, if you are giving a risk management department the mandate to hedge some risks, or if you employ some traders, you should also give them the right incentives, okay? If you tell a trader, look, if you make a lot of money during the year, then I'm going to give you a huge bonus, and otherwise you just get your standard salary. Well, then you kind of give an incentive to that trader to not just hedge risks, but to actually start speculating, right? Because if he speculates, he may make a lot of money and get his huge bonus. If he just hedges risks, then he just gets his standard salary. So it's basically a bad idea to just give wrong incentives to that trader. Yeah, because you're just kind of tempting to do something which he's not supposed to do. Then you should do sufficient monitoring. Okay, so like Nicholas and Barings Bank. Barings Bank should not have just sent him to Singapore and let him trade and just trust that he will be diligent. There should be a back office which is independent of himself and who actually checks what he's doing. Moreover, with like UBS more recently, the system has to be bulletproof. It cannot be that the back office lags behind the trader. The back office needs to be on top of what the trader does so that they actually know how much risk the traders are taking. And on the other side, if your treasury department in your corporation starts to make big profits, and these profits are not justified by some other offsetting hedging positions, then maybe you should try to realize that these guys maybe are not just hedging, that they actually started speculating. So you should keep kind of an eye on these kind of developments. Then you also should think about, if you have a trader who had a very good track records, maybe over the last 5 or even 10 years, that doesn't necessarily mean that he's going to do very well in the future. Okay, maybe he was just lucky. Maybe there are another 1,000 traders who did pretty poorly, and he was just the lucky one who had some very good years. So you should be very careful. Don't give too much independence to a guy who just had a good track record in the past. Try to really think about, was he really smart about it, or may it have been just really luck? And of course, separation of front, middle, and back office. I mean, that I kind of mentioned that before already. Don't let a trader write his own books and be in charge of everything by himself. So this concludes this introduction chapter for us for today.